Let's move beyond just giving you credit and saying you've been right and saying 4,800 is your target and we're basically there. Let's talk about sustainability. How sustainable is this move, Tom, and for how long?
Scott, as a sort of, let's say, our base case, because I know we're into year-end dynamics and everything is unpredictable, especially COVID, I think the rally we're seeing has a lot of fuel. Because we know after Thanksgiving, when Omicron was first reported, that there was widespread panic and hysteria. AAII retail sentiment got to the lowest readings all of 2021. Hedge funds raised more cash, and their cash balances reached the highest levels in all of 2021. So there was so much panic following Omicron hitting, people essentially positioned it as if the market was crashing. So I don't think the rally in the last 5 days has put much cash to work. And I think on balance, the Omicron data is going to look better. Our data scientist, Tireless Ken, is actually forecasting the cases to peak in early January. And I think that means the market's already bottomed in, maybe it's 5,000 in early January.
Yeah. Then what happens? Because if your scenario plays out and your technician's scenario plays out, I've got Jay Powell and company to worry about.
That's right, Scott. I think 2022 is really treacherous. So if we are at 5,000 in January, we could be down by June from there. But I do think for the full year next year, it's a double-digit year, partly because, we're still in a solid expansion. Monetary tightening doesn't kill bull markets, but it creates a lot of volatility in front of it. So I think if the Fed liftoff is in the summer, by December, the markets can look a little bit past that. And so I think we're still up 10% for the year.
I mean, I'm trying to get beyond. I think 2022 is really treacherous. I mean, that's what's going to be cut, right, and spliced out of this interview. And people are going to talk headlines that, Tom Lee thinks you can get out of 21 and into 22 with a bang, but then you could have some real issues. If you think that it's going to be treacherous, and once the Fed starts to get a little more aggressive, let's say by the summer, June, as you say yourself, what kind of pullback do you think we're going to have?
Scott, as you know, in the past 12 months, we had 4 corrections of 4% or more, but every time it felt like the sky was falling. So in 2022, in the first half, I think the possibility of a drawdown closer to 10% is probable. And so I think people are going to be in widespread panic, but that would be a buying opportunity. And then in terms of positioning, I think that's why FANG is our second favorite sector in 2022.
Interesting. Joe, you have a question for Tom Lee?
I do. Tom, you mentioned FANG, and given the significant contribution that it provides, if you are going to have a 10% double-digit decline, wouldn't we ultimately have to see the weakness that we have not seen in those mega cap type stocks in the first half of the year?
Yeah.
Joe, that's a great question because, you're right. FANG is, the market's eventually is becoming increasingly FANG. Tech and comm services is more than 40%. FANG earnings next year are going to grow 30%, and PEs fell in 2021. So I think PE expands next year for FANG. And actually, PE derates and re-rates every other year. So our base case sort of is FANG's up 30% or more. But I think it means that if there's panic around inflation and Fed tightening, the rest of the market takes it on the chin pretty hard. So I think FANG is pretty solid in the first half, and then everything else looks really shaky.
I go, Tom, to what the Wall Street Journal is talking about today, right along these lines. In fact, you've set us up perfectly for it, as Joe has with his question to you. Gigantic stocks are a reason to worry, the Journal writes, quote, owning any company that has mushroomed in value means it is hard for it to outperform for much longer without getting uncomfortably large. Investors increasingly feel safe putting their money to work in those recent winners. Even if they are wonderful businesses, that can leave them overvalued. That is the key risk. What looks to be the most attractive, if not the most defensive, in an uneasy sea. And it's a port in that storm. At some point, even those get overvalued and overextended, don't they?
They do, Scott. I just think one of the dynamics in 2022 is if inflation anchoring is taking place in the market. So let's say investors think inflation, and I agree with Dubrovko, it's actually transitory, but I think that the contemporaneous numbers are going to be big. Investors are going to realize bonds are guaranteed to lose money. You know, one of our themes is guaranteed, Tina, that you're guaranteed to lose money on credit, every high yield bond, every investment grade bond, every 10-year. And so that would make equities your only safe haven if you thought there was inflation and the Fed tightening. And so I think FANG holds up because, you know, the earnings and free cash yields and even the dividend yields are so big in these things, you're better off owning that than owning a 10-year bond.
Interesting. Shannon, you have a question for Tom? And then Pete, I know you do as well, but Shannon, you first.
Thanks. Hi, Tom. Happy holidays. So when we
Happy
talk
holidays.
about, you know, FANG as your second top sector, you've made a lot of really good calls on energy this past year. And how do you see that, especially with the potential for moderating inflation? What is the outlook for energy and materials look for next year?
Hi, Shannon. Yeah, energy is our top pick. I know it was the best performing sector in 2021 with almost a 50% gain, but we think energy stocks could produce similar gains next year, mainly because oil structural deficit, you know, the supply versus demand gap is actually going to get bigger in 2022. So I think the market can no longer ignore that oil has price support, could get into the hundreds. At the same time that, as you know, jawboning by policymakers might tank oil for a week, but at the end of the day, it's supply and demand that's helping set the price. So I think energy stocks, which are under-owned and they're better managed, they're producing a lot of cash flow, and now they're cheap relative to oil. I mean, that's three strong reasons for them to really shine next year and I think outperform FANG.
Yeah, it's an interesting call to be able to back up the kind of year that they have had. We'll see. Pete?
So, Tom, here's my question for you. I know everybody used the expression FANG, but are we talking more than FANG? Are we talking about mega cap tech? And if so, are we also including the subsector of the semiconductors that have had an unbelievable run of late? Are those included in what you're talking about in terms of second half and some of the performance that we would see?
Yeah, absolutely, Pete. Yeah, FANG, I think, is a better word to describe like a type of company, which is a company that has a very high Herfindahl index, you know, large market share, has proven that they don't have to worry about pricing. Their end markets are growing. It describes FANG. It's now describing a lot of semis, as you said. It includes companies like NVIDIA. So I think FANG is a characteristic of some of the best American companies. I mean, at the end of the day, we have to remember, you know, U.S. FANG and U.S. tech leaders, I mean, they're pretty scarce in the world. You can go into any other country, you don't find companies like this. So I do think an alternative, Tina, is that you know, the U.S. stock market's really the safest place to be.
Hey, Tom, let me ask you this. I mean, we've basically, let's just say, since 2009, we've had the easiest money policy from the Fed of any of our lifetimes. I think we can make that statement, or certainly close to it. Can we say that the best days of equity returns for investors are behind us at this point? If you think that it's going to be tumultuous next year because the Fed's going to be changing its policy, and we may only get a 10% rise in the S&P, and then if you figure the Fed is only going to get tighter from there, right? They're going to have to try and fully normalize policy at some point, theoretically. Doesn't that make it much harder for years to come by the returns that we've grown so accustomed to over the last decade at least?
Scott, yeah, I'll agree, because I might just make an observation that since 2009, we all know that more than half the return has come from multiple expansion or the PE expanding, whereas S&P earnings growth has actually been held back because of lack of inflation. You know, nominal inflation picking up actually has a 3 or 4 beta to earnings growth. So the next 10 years, to me, we get less boost from PE expansion. But I think the millennial tailwind, and we've written about it extensively because the number of people age 30 to 50 in America is actually starting to really accelerate, similar to the 80s and into the 90s. I mean, that to me spells that earnings growth probably is structurally stronger. I think it's a possibility that we could compound S&P at 20%. in the next 10 years. So it could actually be better than '09, but it won't be PE. It actually has to be coming from earnings.
Tom, I'm going to let you run. Again, I know you're on holiday, and I do appreciate your time making some for us. I wish you a happy, healthy New Year and many visits with us in 22.
Yeah, thanks to you guys. Wish you the same, and also to all the viewers.
All right. Thanks. That's Tom Lee.